Struggling to get into property investing because you think you need massive savings? In today's U.S. real estate landscape, No Money Down Investing Real Estate USA shows how strategic financing methods can open doors without using personal funds. On Real Estate Capital and Growth USA, we explore how deal funding structures evolve across American markets, all focused on understanding, not advising. We'll also uncover what no money down really means, the core logic behind it, and why it remains a consistent approach used by investors across the United States. Before we dive into the foundational concepts, let's take a moment to clarify that this video is purely educational and informational. It is designed to help viewers understand general frameworks within U.S. real estate financing. Nothing here should be interpreted as financial, legal, or tax guidance. Always seek professional insight when making individual financial decisions. Now, let's begin by understanding the fundamentals before diving into real-world applications. Understanding No Money Down Investing Basics. No Money Down Investing Real Estate USA has become a compelling approach for U.S. investors seeking creative ways to participate in property markets without relying on large personal capital. Across states like Texas, Florida, and California, investors explore structured strategies that leverage available funding channels, emphasizing resourcefulness and informed decision-making. This foundation opens the door to understanding how historical practices and modern tools support property acquisition across diverse U.S. regions. Next, we'll examine how basic principles of creative financing form the core of strategic no money down approaches. Historically, creative financing gained prominence during periods of tight credit in American real estate markets. Investors relied on structured instruments rather than personal savings to secure ownership opportunities. This practice highlights how market dynamics, including credit availability and regional economic factors, shaped approaches to real estate business line of Credit USA, collaborative funding models. At the core of these strategies lies an understanding of deal structures and capital circulation through partnerships and shared financing. States like Florida, Texas, and New York illustrate diverse applications of these models, demonstrating how business credit score real estate investors and lender collaborations influence the creation of property opportunities. Creative financing frameworks continue to evolve, supporting property growth across the United States. By emphasizing knowledge, awareness of economic trends, and collaboration, investors can study high-limit business credit cards for real estate and other instruments to comprehend how ownership structures function in various markets. Having examined the fundamentals and historical context of No Money Down Investing Real Estate USA, the focus now shifts to exploring the mechanism that drives these strategies, other people's money, or OPM, which forms the foundation for structured deal funding across American real estate markets. Introduction to OPM, Other People's Money. No Money Down Investing Real Estate USA often relies on a core concept known as other people's money, or OPM. Across American markets, from New York to California, investors utilize structured partnerships and shared funding channels to participate in real estate opportunities without deploying large personal capital. Understanding OPM lays the foundation for appreciating different funding methods, including collaborative structures and lender-based strategies, which are explored in the upcoming content. Defining OPM. At its essence, OPM represents capital sourced through collaboration rather than individual financing. Investors in No Money Down Investing Real Estate USA study how shared resources, whether from partners, business credit facilities, or equity-based collaborations, create scalable opportunities. This framework emphasizes knowledge and awareness rather than personal action. Common sources of OPM. These sources may include seller-held notes, business lines of credit, or equity collaborations used to support property acquisitions and expansions. Across markets such as California, Texas and New York. Understanding these instruments helps learners visualize real estate strategies. General applications and deal structures. OPM enables flexibility in structuring deals across residential, commercial, and multifamily investments. By studying these arrangements, learners can understand how investors coordinate resources, allocate capital, and design layered structures for hypothetical real estate scenarios, all with a focus on education and market understanding. OPM and No Money Down Investing Real Estate USA illustrates how shared resources and structured collaborations form the backbone of strategic deal funding in USA market applications across states like New York, Texas, and California. Types of OPM tactics. No Money Down Investing Real Estate USA often leverages several OPM tactics that allow investors to structure deals without using personal capital up front. Across U.S. markets, from Texas and Florida to California and New York, these methods create opportunities for property acquisition through strategic collaboration and creative financing. Understanding these approaches provides a foundation for recognizing how seller financing, partnership funding, and lender-based frameworks are applied in various regions. Now, let's break down each tactic in detail to see their conceptual applications. Seller financing. Seller financing allows property owners to participate in funding through flexible payment structures. This method is commonly observed in real estate business line of credit USA scenarios across states like Texas and Florida. By understanding these arrangements conceptually, learners can visualize how creative financial structures operate. Partnership funding. Partnership funding occurs when multiple contributors align resources toward a single investment goal. Across markets in New York, California, and Florida, this approach illustrates how collaboration and strategic capital allocation can support property acquisition without deploying personal funds. Lender-based frameworks. Lender-based frameworks, such as business lines of credit or private funding arrangements, provide structured access to capital under defined conditions. In markets like California and New York, these instruments support strategic deal structuring. Studying these methods helps learners understand how layered financing works in U.S. real estate. Seller financing, partnership funding, and lender-based frameworks each offer distinct paths for conceptualizing no money down investing real estate USA. Across U.S. markets, these strategies highlight the role of collaboration, structured funding, and strategic resource allocation in property acquisitions. Descriptive examples of deal funding. No Money Down Investing Real Estate USA can be better understood through concrete examples showing how layered funding strategies operate in practical scenarios. Across U.S. markets, from the Midwest to Florida and California, investors combine seller financing, partnership contributions, and business credit lines to structure deals without relying on personal capital. Examining illustrative cases helps learners visualize how coordination, transparency, and creative use of resources allow property deals to be funded across diverse U.S. markets. So, let's explore a sample scenario to see these principles in action. Layered funding example. Consider a property valued at $250,000 in the Midwest. The seller is willing to hold partial financing, reducing the immediate need for liquid cash. A partner supplements the deal with a business credit facility, creating a layered capital structure. This scenario demonstrates the interplay between seller participation and external funding. Illustrative variations across regions. Similar approaches are observed in other U.S. regions, such as Florida and California. Investors conceptually layer financing through real estate business line of credit USA and equity collaborations, adjusting strategies to local market conditions. Conceptual case study. Hypothetical case studies demonstrate that coordination and transparency underpin successful funding arrangements. Mapping resources across multiple contributors and financing channels helps learners understand deal construction, risk management awareness, and strategic allocation in the U.S. real estate context. Illustrative examples of no-money-down investing real estate USA highlight how seller financing, partnerships, and business credit contributions combine to form layered funding structures. Across U.S. markets, these examples emphasize understanding market mechanisms, collaboration, and resource allocation. Market considerations for USA real estate. No-money-down investing real estate USA strategies vary significantly depending on regional U.S. market conditions. Coastal cities such as Los Angeles, Miami, and New York often present higher capital thresholds, while central and southern states, like Texas and Ohio, demonstrate more flexible approaches to creative financing. Recognizing how local economic conditions and capital availability influence OPM structures sets the stage for understanding strategic decision-making across diverse markets. Let's explore the main factors shaping funding opportunities across the U.S. Regional differences. U.S. real estate markets demonstrate significant variation. In high-demand coastal areas, funding arrangements often require layered financing through Real Estate Business Line of Credit USA or partnership contributions to accommodate competitive pricing. In central regions, investors may conceptually leverage more flexible seller financing models or local business credit structures. Macroeconomic factors. Interest rate trends, credit availability, and overall economic indicators shape how OPM can be utilized conceptually. In markets experiencing rising interest rates, layered financing strategies such as combining private money lenders for real estate deals with partnership contributions become more visually relevant for understanding market adaptation. Trends in property deal structures. Across U.S. markets, trends such as the use of business credit score real estate investors and multi-contributor funding illustrate patterns in deal structures. Coastal and central markets may differ, but the educational takeaway is the consistent role of structured collaboration, strategic resource allocation, and OPM-based models in shaping property acquisitions. Understanding regional differences, macroeconomic factors, and emerging trends provides insight into no-money-down investing real estate USA. Across U.S. markets, investors can conceptually analyze how OPM structures, partnerships, and business credit mechanisms combine to shape property deal frameworks. In conclusion, the OPM strategy in Real Estate USA demonstrates how collaboration and structured partnerships can expand access to property opportunities while maintaining responsible financial management. By understanding this framework, participants can better navigate the evolving landscape of U.S. real estate funding. For more in-depth educational content on U.S. real estate financing frameworks, subscribe to Real Estate Capital and Growth USA, and stay informed about future topics on property funding and strategic market analysis. Thank you for watching and see you in the next videos.